And we're back and making some stock market videos. I said if I get bored in the next few days, I'll come back and start doing some videos a little bit earlier than planned, and that's what happened. I'm a little bit socialised out from the last few days. So let's get stuck back onto the stock market videos and stocks and what's going on at the moment. And today we're going to talk about the UK stocks that I'm buying in January 2023, and these are the stocks that I've been buying in the last few weeks, moving into January. And I'm just going to share this with you guys just to keep up that transparency, so you guys know the moves that I'm making, especially right now in this bear market and this what has been a horrible year. So let's get started on these stocks. Now, as always, if you want to know what I'm buying and selling in real time, the place to be is on the Patreon. If you join through there, I post my buy and sell alerts in real time, as well as a Discord with 600 members on to talk to about stocks, and as well as that, there's 2 exclusive videos a week on the Patreon. So, in my opinion, definitely worth the £5 a month that it is for the time and effort I try to put into there. So, if you do want to join, links in the description. But let's get stuck onto these stocks. Now, there's 4 on this list, starting with this one. We talked about it a few days ago, which was National Express. So we talked about this 5 days ago. As you can see here, there's a video that I put out which was about 14 minutes long. Basically, National Express obviously is what we will know in the UK as a coach company, but it actually operates internationally through a lot of other coaches, buses and train services as well around the world. The likes of Ireland, United States, Canada, Spain, Portugal recently, Malta, Germany. So there's a lot of areas that they are operating in. Now at the moment, I look at National Express, and if you look at the stock price, it is absolutely being beaten down in the last few weeks. You can see here that it's now at the levels it was at the bottom of the pandemic levels. It's now at the levels it was in the pandemic. And if you actually zoom out a little bit further, the share price is near the Great Recession prices, which just shows you how much negativity is priced in here. The likes of the Great Recession and the CV times, which, you know, that was a time where you're like, well, these buses are never going to get operating again at full capacity. You know, them sort of peak fear times is where National Express is priced at right now. And I'm like, for me, this is just way too low to be at these sort of levels. And I did pick up some shares. I'm just being a little bit cautious at the moment, and I'm not trying to go all in, but it's one that I'm definitely nibbling at the moment. Now, when I look at National Express, you'd think, like, when you look at the share price, the company's performing absolutely terrible, and it's anything but that. They finally got to a level that they're very close to where they were at in the pre-CV time. So when the stock was here at, you know, that £4 range, it's now getting to them sort of levels on a financial point of view. So if you actually look at the recent trading statement, which was on the 20th of October, they said that revenue was up 33% year on year and 5% ahead of 2019 levels. So that is obviously really impressive. You also look at the areas that they're in. ALSA was up 35%. They said that Morocco continues to do very well as well. North America grew 11% year on year. And as well as that, there was a lot of weakness about trying to get drivers over there as well. So to say they've had that issue and it's still doing very well, that's great. UK and Germany were very strong. They said that the German rail business was up 63% year on year as well. They said that they're also protected from the inflation and also the fuel hedges at the moment, because obviously fuel's gone up so much. They also said because of they're a bit of a debt heavy business, they're at the moment 80% of their debt is fixed. So even though interest rates are going up, they're not obviously going to be affected. Not next year, the year after, and obviously by that time you're hoping that interest rates have kind of calmed down. So the 2 issues that you would associate with National Express have obviously been dealt with here. And the great thing is they just continue to win contracts. You can see here that on an earlier update, which was their half year results, so this was posted, let me just scroll up to the top, 28th of July here. Not in the trading update, the half year results beforehand. You'll see here that they had 16 new contracts won in that time frame. So they're just winning more and more contracts, and they also entered the Portugal market, and they're entering new spaces like here. And I think the more they win these contracts and have a good reputation, they're just going to continue doing very well. And in a time frame where in the UK we're being hit by massive amounts of rail strikes, National Express is actually benefiting from that by putting on more coaches, and they're obviously doing well from these positions of weakness at the moment, and that's what's led them to do very good financial results. So you're looking at the business at a 0.3 times sales. On an earning basis as well, it's looking pretty cheap, and you can see here they're actually now going to put a full year of profitability in, and that should carry on ramping up now, and also the revenue should carry on ramping up, as you can see here. The issue obviously is around the balance sheet. The balance sheet has always been a little more debt heavy, as you can see here. They sit on 81% debt to equity, but as we spoke about a little bit earlier in the trading update, you'll see here that they say that 80% of its debt is currently fixed at the moment to 2024, so that's not really an issue. There is one issue at the moment going around potential strikes inside the National Express business. So the drivers at the moment got a pay rise, which was a 14% increase, but the engineers were actually offered a 10% increase, and the engineers at the moment want 14% like the drivers. So there is that currently going on in the West Midlands area at the moment with the engineers, and I think there's some fear priced in there that goes to the engineers across the whole of the UK, and then that takes some of the business down in the UK. So maybe that's some of that is getting priced in, but that was obviously on the 14th of December, and if we do look at the share price here, if we look at the 14th of December, that was only 16% of the drop. So clearly there's a lot more fear kind of going on in there than just that kind of strike issue that's going on, but that's something to be careful of, I think. But I look at this stock here, it's now performing way above 2019 levels, and it should continue with the contracts it's winning and the areas it's expanding into. And then you're looking at something like the share price, and the share price is at the levels it was at in the CV times, the 08 times, and there's just too much of a disconnect in here. I can understand why this stock would be selling off a little bit because of the issues and the concerns of a recession out there, but people still need to travel. People still need to travel on the daily life, going places, getting to work, especially as the remote working is kind of disappearing now. I think that National Express is a need stock that will continue to do very well. So I think the sell-off here was way too much. So I have been picking some shares up in National Express. The next one is Airtel Africa. So this is a stock that I've owned for around about 2 years. I was up over 100% on this position. But I've started to do a lot of averaging up on the position, so I'm around about just over 20% I think up on this position. So there's a lot of averaging up in that position, and also because the stock's down 31% is why that I'm only now 20% up. But I'm trying to build this into a really big position. I think it's one of the UK stocks that just goes so quiet under the carpet, and it just gets no attention for some reason. Trades at 7 times earnings, pays nearly a 4% dividend yield, we'll call it, because it is 3.93%, close enough to 4%. They're a telecommunications and mobile money service in 14 countries in Africa. What I like about this is that I think that the stock is always being valued a little bit low because it might have some political risk to it. But the fact that when you're in 14 countries, I think that kind of cuts out some of that political risk. So I'm kind of quite happy about that. Same again when you look at inside the business, voice revenue, which is obviously a slower part of the company that's growing at the moment, but the biggest. Grows at 12%. If you look at data revenue, which is the growth of 3G and then moving into 4G, and 5G has not even started in Africa yet at the moment, which is another growth area in the next few years once we have the 4G ramp up. This is going to be a fast growing area. A lot of people in Africa at the moment use phones and use their phones for data rather than the traditional Wi-Fi system that we have built up at the moment. That hasn't really been built up at the moment, so data is used massively in Africa at the moment, and that's why it's growing at these sort of rates. If you look at mobile money, this is a massive growth area as well. It's the smallest part of the business, as you can see here, but that's growing 39.5% from here. And the reason why is because, once again, the traditional banking system that we're used to hasn't really been built up in Africa, so it's very easy to use mobile money apps and use that to pay for things, send money to each other, and that is one of the biggest areas in the world for mobile money at the moment, and Airtel Africa have that at the moment, and it looks like potentially they will spin this off in the next few years as this ramps up. So I would expect this to put in some serious amounts of growth, and could come actually the biggest part of the company in the next few years. So that's something really to keep an eye on. You can see here that 3G, one part of Africa here, that 3G is still very dominant and will account for half of the total connections by 2025. This year was a turning point as 3G adoption began to decline for the first time, and by 2025 4G will account for a third of mobile connections in the region. And so you look here, like 3G has just come dominant, and now that's kind of peaked, and now the move to 4G happens. And then after the move to 4G happens, you then have the move to the 5G. So there's still massive amounts of adoption growth here for 4G and then the 5G. And then when you look at the mobile money point of view, mobile money is still growing massive. You can see here Africa accounts for 70% of the world's 1 trillion mobile money market. This is a massive growth area as well. And if you look here, the Africa's mobile money transactions edged up to 39%, which is crazy in 2021 as well. So that shows you the amount of growth that's going on there. So when you look at this business, the growth rates are obviously fantastic. You know, the revenue's growing at really good rates, profits growing at very good rates. And if you look at financial health-wise of the business, they used to be a little bit debt heavy. They're now paying a lot of that debt down, which is, really good as well. And there's been a lot of buying on the insider front. And like I said, you're picking up nearly a 4% dividend here. And obviously, when you look at the growth and the dividend, I think it's obviously a really good opportunity as well. So I really like this one. The next one was S4 Capital. So this is obviously, as you guys know, one of my favorite UK growth stocks. I think that we don't really have that many gems in the UK market of growth stocks, and S4 Capital is one of them. And this stock has been absolutely battered. I mean, it's now down at the levels close to, when it IPO'd. It's about the same levels that were in 2019, and it's a massive better business than this. Obviously, S4 Capital involved in the digital marketing space. So you can see here, this is a case study for one of the platforms that they own, which is Media Monks, and it's on Netflix. And you can see here that they had how they can create tailored ads. They also have, cost cutting. They have more impact for these sort of ads. And it's supposed to be more efficient and also get better results for a lot of these companies that they work with. There's a couple of other ones you can see here for Starbucks. So you can see here that how they created 127 assets out of a 3-day shoot, and how they use all of them on different channels, and it's lower cost, and they save up to 50% of the money. So this is the marketing business that they can run. As you can see, an example here for some of their clients like Starbucks and also Netflix. If you look at the stock in the last few months, they did come out with a bit of a profit warning, which was on the 21st of July. Now, funny enough, already by then, if we actually go to July time, you can see that little drop off that we have around about here. That was the profit warning, which did cause the share price to drop about 50% down there, which has since then kind of recovered most of that profit warning. But this share price has been falling since 2021, and the big frustrating thing of being a shareholder here through this drop here is the drop wasn't really justified. Like, during this time frame, the business was actually performing very well, and the share price just kept going down and down and down. And by the time we actually had something that was a little bit like, oh, that's not good news, and it still continued to drop, you're like, why is it dropping? Because we've already priced in so much negativity. So I think this stock should be a lot higher now from where it is at the moment. And the profit warning was really not to do with the revenue growth. The revenue growth has still been really good. It was actually to do around the profitability. And they basically came out and said, well, we've hired probably too many people, and we need to reduce this, and we should see this sort itself out in the back end of the year. And actually, S4 Capital then came out with a trading update in November, and they said that growth is still doing very well. As you can see here, gross profit net revenues up 29% year over year, and they did, as you can see here, they improved their EBITDA, and they're back in line with targets that they set on the last trading update. So the business is back in a good point, apart from that little mess up where they hired too many staff. So we should see them get back to a point. As you can see here, they've always run it, near a break-even point, and then we have the little dip where they got a little bit too high on the costs, and they're just starting to pull that back in, where they're back at a break-even point, and then focusing back on the growth, which I do really like. And obviously, when you look at this, this a really high, good that they break even, they're not burning through that cash balance. They're still growing at really good rates, and you look here, and I think the company's like 1.2 sales. You look at the financial health of the business, it's still pretty healthy at 36% as well, which is great. And you can see here, since that profit warning came out and that share price took a real big dive, there has been a queue of insiders buying up some shares as well, which is obviously a really positive sign in the business. So yeah, I think this is a gem of a UK tech company that we don't really have. I think that the fact that this is down at £1.79 is absolutely ridiculous. I think we should be talking about S4 Capital in that kind of £4 or £5 range. So I think it should be a lot higher than you factor in the growth as well. I think it's a really good stock. So yeah, I'm a big fan of this UK growth stock. And that leaves us with the last one, which is Catebox. And Catebox for me is a bit of a value and dividend play. So it sits at 9 times earnings, which I think is still a bit too cheap for this sort of business, and it also pays a 6.7% dividend yield, which is massive as well. You see here that Catebox is, once again, this is very much near its IPO price. It's actually below its IPO price, which is crazy. They did have a bit of a share price run up in 2021, as you can see here, and then since then the stock has fallen down massively. Once again, this was basically not really due to any reason at all. There was an issue around the counts, which it did fix. They did have a little bit of a profit warning down here, which caused nearly a 50% drop here, as you can see. But once again, I'm looking at a stock that's been massively overdone. Like, this stock should be nowhere near the levels it was when it IPO'd, and a lot of the issues that it's had is, it's definitely resolved them. And obviously, as you can see, they do a lot of these cakes here. They also do little buns that you can go into, go get. They do this from actual shop locations, which at the moment, I think through the franchise model that they have massive room for expansion. Even in the city that I live in, there's massive room for expansion. They have some little mini pop-up stores, which I'm a big fan of as well. And also they are starting to expand through supermarkets and kiosks as well in supermarkets, which should also do really well for them as well. I'm really a big fan of them expanding these smaller locations, and I've had some of their cakes before, and they're really good as well. So the profit warning they had was in the 31st of August, and they basically came out and said that they've seen a challenging environment and sales have slowed down. Like sales did decline 2.8%, as you can see here. So they saw a bit of a slowing sales through this time period, which was due to, they said, lower footfall, the heat wave that was going on. So that a lot of travel as well, so that affected the business here. But I mean, it was already dropping before this point here. Recently they came up with another trading update, which was on the 14th of November, and basically said, since we saw this summer period or summer holiday period finish, we started to see a recovery again, and it was a bit of a blip, and we've gone back to good sales. You'll see that if we actually go here, they can see that like-for-like sales was actually 3.6% in September, so that moved back into positive direction. Gross margins were still doing very well. They had the new stores opening as well, and you can see the growth in October was even stronger. And when you look at the business here, I mean, the past few years, this stock has performed really good. I mean, look at the revenue growth and profit growth of this business in the last few years. And like we were saying, this stock's now getting valued back at the below IPO prices in 2018. And you look at the business, and it's just absolutely insane, the progress that they've been making. And if you look at the financial health of the business as well, I mean, there's 8% debt to equity on there, absolutely amazing balance sheet, 5.7 million in cash for a 56 million market cap company as well. And like I said, you look at the dividend, it's a 6% dividend yield as well, which is great. And once again, during this time of weakness, what have we seen? We've seen big insider buying here, as you can see here. The actual CEO and founder as well came in with a massive buy on the 31st of August. He then followed up with one on the 20th of September as well. And if you actually look at the insider holdings of the business, you'll see here that he actually owns 25% of the business as well, which is a really good amount. So yeah, I mean, that's what you want to see. There's some weakness here in the share price, and you're just looking at it going, why is this dropping? And then you have the CEO and founder coming with a massive buy here. Just gives you a good amount of confidence as well. So yeah, I think that this is another stock that has just been beaten down way too much, and is what has been a fantastic company performing financially in the last few years. It's just been massively oversold. So those are the 4 stocks that I've personally picked up recently, and you can see a bit of a common theme with them, that they're all kind of being beaten down in this time period. There's a lot of stocks that are being beaten down, but I'm looking at these stocks and going, okay, these are being beaten down way too much. Even though there's some issues going on in the UK economy at the moment, they shouldn't be at these sort of levels where we're talking levels that were at 3-4 years ago. For some of them, back at IPO prices or below IPO prices from 3-4 years ago. I'm just seeing too many beaten down stocks here that I am taking these opportunities to buy them. So hope you enjoyed the video anyway, guys. If you could hit that like button, that would be absolutely amazing. If you're new around here, subscribe, and I'll catch you in a bit.